VOO is considered to be the holy grail of the stock market. It tracks the S&P 500 index, which has a very consistent return, has survived multiple market recessions, and is very recommended by some of the biggest investors in the world like Warren Buffett. But what if there was an ETF that could beat out VOO? After hours of research, I found one called VUG. Not only does it have a superior price performance, but during a recession, it loses less of its value. Taking a look at this graph, the blue top line is VUG and underneath that is VOO. You can see that consistently since 2012, VUG has been winning with a much greater increase in its share price value. I'll be comparing how much money you would make in comparison through investing in VOO and VUG and show you the clear benefit and how much VUG will actually beat out VOO, especially the longer the period of time that you invest. For these examples, I'll be putting in $100 every single week, and if you work this out on roughly a $50,000 salary, that's just under 10% of your income. So the average return for VOO across 10 years is 12%, and as we said earlier, for VUG it's 13.08%. Now that small 1% difference has a massive impact on how much money you're going to have at the end of your investments. For VUG, if you're putting in $100 a week at that standard 13.08% interest, you're going to have $392,196 in comparison to VOO, which will make just over $345,000 across the same period of time. So with VUG, you would have made an extra $46,000 in comparison to VOO. Now that small 1% difference definitely adds up, and the longer you spend in time investing, the greater that difference becomes. Across 30 years for VUG, you'll have made just over $1.4 million in comparison to VOO, which would have made just over $1.15 million. So there's a $271,000 difference between these two ETFs. Now for the last example, across a 40-year period, VUG would have made $4.97 million. Of that, $192,000 is from your own money and $4.78 million is just from compound interest. For VOO, it's $3.68 million. So by the end of it, there's a $1.29 million difference between VUG and VOO over a 40-year period. Now of course, depending on your age and how much money you have available to set aside for investing, these results will vary for you. If you are a little bit older, you might not have 40 years for your money to grow and compound, but you can see from all of these examples, there's a clear benefit to investing in VUG over VOO in the total price performance that you're going to have. And regardless of how much or how little investing experience that you have, anyone can replicate these results. All you need is an automatic payment from your brokerage platform into VUG and just have a set amount of money that you don't need to touch for anything like rent, food, or other personal expenses. If it's money that you don't immediately need for living and you can cover all of your expenses and it's fine and not a problem if it sits in one of these ETFs and gains interest, then you can just set up that automatic payment and replicate these results for yourself. Because I always thought that there was lots of technical analysis and all this market research that you had to do in order to actually make money from the stock market. It's what most people think, it's what you're always sold on advertisements. Something else that also has a great compounding effect is dropping a like and subscribing to the channel to make sure you maximize all of your stock market knowledge. Let me know down below in the comments what your favorite ETF is so far. At the moment, I'm really liking VUG and I'd love to know what your investments are looking like as well. So next we'll be jumping into what VUG actually is, the different companies that make up the ETF, and the management strategy for it as well. So essentially, VUG seeks to track the US large cap growth index. Essentially, this is a collection of some of the largest high growth companies that are available predominantly in the US stock market. The thing I really like about VUG is the strong criteria for selecting which stocks can be included in the ETF. Some of the criteria criteria include expected long and short-term growth in earnings per share. Some of the top 10 holdings include big names like Microsoft, Apple, and Amazon. The top 10 holdings account for roughly 45% of the total ETF value. If you look at the total amount of companies held within VOO and VUG and the overall market value of each ETF, there is quite a big difference. For VUG, there's $74 billion in assets under management and 249 different companies. VOO has a total market value or assets under management of $275 billion and has just over 500 different companies included. The lower market value and reduced number of stocks could be perceived to be a limitation of VUG, but if you look at the 5-year performance, it doesn't seem to have had a major difference so far, with VUG being the orange line on the graph and having gone up 418%, with VOO is the blue line and that's only gone up just over 360% across that 5-year period. Some people may prefer to have a bit more diversification, and VOO will be better for this, especially since almost 50% of the total ETF's value is held within the top 10 companies when you're looking at VUG. VUG is also passively managed. This means that the expense ratio is quite low at 0.04%. So if you had invested $10,000, you would only pay $4 in fees. Passively managed funds are normally much cheaper because no one is selecting which companies are held within the ETF. When funds are passively managed, there's no one that's being paid to actively select which stocks are held within the ETF, and this really does help to cut down the overall price. Taking a look at the ARK Innovation ETF, which has an expense ratio of 0.75%, which is almost 20 times greater than VUG, and that expense ratio really does add up over time, especially if you're dollar cost averaging. Taking a look at VUG's main sectors, about 45% of them are based in technology. Then you also have consumer discretionaries and industrials as well. Some people might not prefer to have near 50% of the total ETF held predominantly in one sector, which is technology, and historically technology based companies can be very volatile and they tend to have a bit more of a downtrend during a bear market. They tend to go up in value more during a bull run, so you do have to balance out that risk versus reward with how much stability you want in your portfolio. About 24% of VUG's whole market value is held within Apple and Microsoft, and these are some of the biggest companies in the entire world, and they are very stable as well, so they are quite a good anchor for the ETF. And during the most recent bear market, they've both only come down about 12%, which is very close to the overall reduction in market value, which if you're looking at the S&P 500 index has been down 8% this year so far. So they are very stable companies to hold the total value of the ETF nice and high, and will more likely than not be able to retain the value of the ETF and make sure there's not a major drawdown during a bear market. It also has a dividend payout of 0.64%, so for every $10,000 that you invest, you'll be getting $64 back. So not a massive dividend, but it is still quite nice to have. While that dividend isn't very impressive, and you might be someone that prefers a more passive investing approach, and ideally you would like to be able to live off your dividend income and not always have to be at the mercy of waiting for your ETF to gain share price value. If you're someone that likes a more passive investing approach, then make sure to check out this video on screen where I'll show you some of the best dividend ETF options and how you can actually retire from them as well, so you can have a truly passive source of income no matter how much or how little investing experience that you have.